Hello there and welcome. Yet another episode, a quick one from Equity Story. Today we are in Krakow, so down south here in Poland, at the Investment CUF conference. And my guest is Pawel Maj from Warsaw Equity Group. Welcome.
Hello, welcome. Thank you for the invite.
Well, lovely for you to spend a few minutes here with us.
Of course.
Much appreciated. I suppose I will because obviously, loads of people here, massive networking opportunities as well. I'm sure quite a few people want to talk to you, get to know you as well. So there's a lot of networking, a lot of mingling, loads of interesting panels. So we'll try to make this short and sweet. So, without further ado, first question. So in 2023, what do you reckon will change? What is going to be different when it comes to the Polish startup scene, investment, any investment activity, etc. In contrast to say 2022, 2021? What do you reckon? What's your take?
Well, the Polish startup ecosystem, it's very dependent on the situation that's happening all abroad, Europe and the US. What we have seen globally, actually, the amount of dollars invested into startups have drastically decreased in the last 18 months, about 66%. So the amount of invested capital decreased by 2/3, actually. So it's a dramatic change. Less in number of investments, more in the amount of capital being invested, especially the later stages. So we have seen it in Poland already. So far in the reports from 22, we see that the Polish startup ecosystem have not grown, but also have not shrunk. So the amount invested was very similar to 21, which is actually a big success compared to
considering
what's happening, especially in the States, where we have seen these big drops. However, Polish startup ecosystem is very dependent on public money, on money coming from local government fund of funds. And most of these programs are just ending, are either ended or they will cease to exist in the next few months, by the end of 23. So what we are expecting is that especially the amount of money to be invested at the pre-seed stage will dramatically decrease. The startups at Series A and above, which are able to fundraise from international investors, will have a little bit easier. But startups that are dependent on local capital will have very difficult time in the next 12 to 24 months, actually.
I see. Well, it's one of these things. I mean, it's presumably, in terms of these programs, it's a temporary stop.
Well, it's a halt because the Polish institutions like PFR, Polish Development Fund, or NCBR, National Center of Research and Development, they already announced new programs through which will finance local fund of VC funds. However, these programs were not, they were announced, but they are not operational yet. And are looking from the perspective how much it takes for the formalities for these funds to be operational. It will take most likely between 12 to 24 months for most of this money to be deployed, at least to the hands of the VC managers.
And the sort of end customer, should we say. In terms of how the Polish startups and as investments effectively are affected by the current investment sentiment in the US and the Western Europe. For example, what happened with this Silicon Valley Bank, the general global situation when it comes to the financial markets, the money supply, and the situation in Ukraine. How do you think this all kind of plays out into the investment cycle here, and for how long are we going to have to deal with the sort of consequences of what is currently going on? Are things going to change in the foreseeable future, stabilize a bit, or is it just?
Well, it depends on the perspective that you have. If you look from the perspective of the last 2 years, when you had a great run or the great investment cycle, from the historic perspective, Never before so much money was invested in a short amount of time into the startups at every stage, actually, from the pre-seed to seed, even to like a pre-IPO.
So business is booming.
So business had been booming. So answering to your question, I expect the market to go back to the normal, to like a long-term trend. So I don't expect anytime soon for the market to come back to the amount that have been invested into the startups, to the valuations that we have seen. To how easy it was to finance by the startups from going to the market to receiving term sheet and sign investment agreement. I expect the market to go probably within the next 12, 18, 24 months to long-term normality, which will be way below what we have seen in the last 2 years. So I expect the market to come back to like a pre-COVID levels. Look at the valuations or look at the amount invested. So if you expect or if you have the expectation of the market coming back where it was a year ago, no
chance.
I mean, we see, the last such period of time we had in '99 during the dot-com bubble. Now we had for the 2 years the post-COVID bubble, and probably we have to wait for the next such bubble or so. Founder-friendly startup ecosystem for the probably next 10, maybe 15 years.
I see.
But right now, the market's never in equilibrium. So during the last 2 years, we went to euphoria. Now we went back below the long-term averages. Everyone sees the future only in the black colors. As I said, in the next 1 or 2 years, I expect to come back to the long-term averages. How the Silicon Valley Bank affects the situation. Likely we don't have seen the black scenario when the bank goes under without any government protection. We have to remember that Silicon Valley Bank was an exceptional institution that was
kind of quite concentrated.
Exactly.
Yes.
About half of the US startups that receive VC funding had their money located in this bank. A lot of VCs actually banked with this bank. The GPs, the managers of these funds, also they banked with this bank and had the money
kind of
deposit.
all pulled at the same time, haven't
also,
they?
Silicon Valley Bank actually loaned the money to the VCs, to the startups, and to the fund managers. So, although it was like a medium-sized regional bank, it was a key, like a cornerstone bank to the startup ecosystem, mostly in the US. But also the foreign startups actually did fundraise from the VCs from the US. A lot of them actually opened a bank account also in the Silicon Valley Bank. So even if I look at the Polish startups who had like Series A and above, and among them there were VCs from the US, most likely the startups also had their money deposited in the bank. So yes, most of the Polish startup ecosystem was not dependent on Silicon Valley Bank, but this startup that had Series A and above, among US investors, actually they could be affected. But of course, right now the problem is a little bit bigger because right now the clients who have deposited money in the regional banks, they ask
the confidence issue, isn't it?
This is the issue of confidence. What happens if another bank will fold? Will the U.S. government step in and protect the deposits of the money deposited in another bank? So this issue of confidence,
of trust in the system, yes.
But
course,
also there's an issue of the money being injected into the startup ecosystem because yes, this is a very unfortunate situation when we have coincidence, or maybe it's a consequence of less money being flown from the VCs to the startups. Right now, also Silicon Valley was an important player in the venture debt. So right now we have the question: how much venture debt will go into the startup ecosystem? So also there could be like a midterm and long-term consequences. I would say that it's not a coincidence that actually it's we see more and more results of the cooling down, not only of the economy, but also of the startup ecosystem. It was one of the reasons of the fall of the Silicon Valley Bank, since it did not have the new injection of the cash into the bank from the startups. Startups were pulling back the cash to cover their burn rate that they had, and there was not a lot of new rounds that actually would put the money into the bank, and the bank was not ready for it. So I would say it just right now we see the more and more consequences of the macro situation actually. You asked about the war in Ukraine. The Polish startups ecosystem was very resilient to the war. Actually, the Ukraine startup ecosystem, to some extent, was also very resilient. Of course, they had problems with fundraising, but actually they were able to control the burn rate and actually to survive and actually thrive some of these startups, even to grow, expand, have new customers.
In spite of what was going on
exactly.
There, which is incredible.
Exactly. It is incredible.
Yeah.
So unless the war will spill outside Ukraine, into the end of the EU nations, including Poland. God forbid, but this is like the black scenario. But if it will not happen, I don't see any real consequences in this region.
Oh, let's hope it doesn't. The dark scenario doesn't materialize. Last quick question. So, in terms of people in wanting to invest into startups, in your view as an investment professional with obviously Warsaw Equity Group, what is the best and most efficient way to hold an investment in a startup, and for whom? So I'm thinking about direct investment, perhaps investment into a fund that invests itself into startup investments, into startup companies, or maybe a network of angels. What do you think? And so what will be good and for whom in terms of getting exposure to the startup world?
So to start answering to this question, I should note that in the long term, venture capital is one of the best performing asset classes. When we compare to the alternatives, to the public stock exchange, to private equity, to alternative asset classes like money market or property market, venture capital, it's among top 3 performing asset classes in the last 5-10 years, actually among top 2. So it's a great asset class to be in, to invest your money. So the question is how, as you asked. I would say that it is the best performing asset class, or among top performing asset classes, but also the one with the highest disparity, with the highest volatility. So even though investors, when you look at the median returns, they are able to generate greater returns. There is a big spread among the top investors and the investors that are in the bottom bracket or quartile. So at the beginning, the best way for an individual investor to approach this class of assets, first of all, is to invest only a small portion of your assets. First of all, especially that venture capital, as almost no other asset class, it has very small liquidity. So you have to commit your capital for a very long time.
Yeah, it's quite risky as well, isn't it? So, I mean,
but even if your portfolio is performing well, but you invested the money, and you need cash here and now, but the foreseeable exits from your portfolio will be 5 years from now or 10 years from now. It will be very difficult for you to
extract the cash as and when you need it. Yeah, it's not a savings account in the bank, right?
You know, it's not a public market where you can just sell your shares. It's not even like a property market where you can
flip a house or
or whatever. In this case, you have to most likely you have to wait until you have the exit or at least IPO, or maybe there's the next round, and new investors are willing to commit
buy
part
the
of
shares off you.
Exactly, to the so-called secondaries. So first of all, you should commit probably less than 10% of your asset that you want to invest into the startup.
So essentially, the money that in terms of like the portion of money you will not immediately need. Hopefully,
I mean, you have to think about even not 5, but probably most likely 10-year perspective. Me as the fund manager, when I establish a new fund, the fund is established for the next 10 years. In the first 4 or 5 years, I invest in the new portfolio. Then I do the follow-ons, build the value, and within the year 6th and 10th, I'm looking for the exits and to liquidate my portfolio. So it's a 10-year journey actually. So it's not a sprint; it's a marathon. First of all. Secondly, if you don't have the experience, probably the best way to start would be to either join an angel network and co-invest with other investors to share your pipeline, share the experiences actually, share the know-how. Because the worst thing that you can do actually to jump right in without any experience and invest much more than you should in very short period of time and had very undiversified portfolio. And actually, I have seen, unfortunately, with my own eyes, or I know the very successful entrepreneurs who exit from their even more traditional businesses, liquidated their assets, and they decided to invest in startup ecosystem. Very quickly, they built the portfolio without knowledge, network experience, and actually, these mistakes were very costly. So I would say start slowly, either join a business angel network, or maybe consider to become LP or investor, limited partner in a venture capital fund, where actually you invest passively through the fund, but actually you should have the possibility to see how this the managers of this fund, how they work, and to learn by working, and then after a few years of getting the experience and building the network, maybe you'll be more eager to decide to invest directly. And lastly, especially at the early stage, if you decide to invest directly, if you decide to invest by yourself without support of the angel network, which I strongly discourage you to do at first, at least if you do it, decide how much money, let's say you have 100 units to be invested. Invest this 5-10%. And especially if you invest at early stage as the business angel, spread your amount, spread your ticket among a large number of investments. So do not concentrate your portfolio.
Yeah.
Invest instead of investing in 5 startups or 10 startups. Consider to invest in the next 5 years, maybe in 50 of them or 100 of them. So let's say if you have 100K, don't invest, 10K in 10 startups, maybe consider to invest 5K in 20.
Yeah, spreading your eggs
Exactly.
without all in the same or 10 baskets, really.
And especially in the pre-seed and seed, the data shows that actually you should not be aware of the risk, or you should not be afraid of the risk because it's part of the game.
Of course.
But you have to give yourself the possibility to have more home runs. So to be at the base to bet like in baseball. So to have more betting chances. So you have to invest in large amount of startups, and then you increase statistically your probability of hitting the winner, and then disregarding your intuition, you have smaller risk of failing on your whole portfolio actually.
Well, ladies and gentlemen, talking about responsible business risk taking here with Pawel Maj from Warsaw Equity Group. Thank you so much for coming.
Thank you very much. It was a pleasure, David.
Well, it was pleasure all mine. Fantastic.
Thank you very much.
Cheers.